Tomorrow is going to be critically important for AMC as well as the broad markets. Due to where the markets are sitting on a technical basis, what we just heard from Snapchat earnings, it's going to be huge what Fed Jerome Powell does say, and I want to give you guys the rundown of what to expect before 2 p.m. and before 2:30 p.m. Keep in mind, 2 p.m. is when the FOMC report comes out. 2:30 p.m. is when Fed Jerome Powell gives you the speech. He gets up there on his podium. He reads out a pre-written statement. So that information is not going to be new, but it's the questions that reporters ask that usually move the markets the most. So when you add all of this information together, you're really at a critical moment in time for the stock market. And really, the markets have rallied a lot heading into Fed Jerome Powell, guys. So we have a lot to discuss in a very short amount of time. You guys might be asking yourself, how does this all pertain to AMC? Or how would this help or hurt AMC? Well, we'll also get into that here in this video. Hit that like button and subscribe to the channel. If you are new here, consider sticking around a while. If you guys want access to all of my trades in real time, link down below in the description of this video. So this article says Fed expected to slow rate hiking to a quarter point, but will stay unrelenting in inflation battle or in its inflation battle. Sometimes these headlines don't read right, but it says the key points: the Federal Reserve is expected to raise interest rates by a quarter point Wednesday, its smallest increase since it began hiking rates last March. Market pros are expecting Fed Jerome Powell to sound hawkish, meaning he will lean towards tighter policy and keeping interest rates high. Quote, Powell is more focused on inflation going down and staying down than trying to help the S&P 500, said one strategist. Quote, his legacy is not going to be determined by where credit spreads are or where the S&P is going. It's going to be determined by whether he slayed inflation and stayed down. Now, what's key about that is the Fed does not want the markets to loosen financial conditions. What loosens financial conditions? When bond yields drop, it makes borrowing money cheaper because ultimately lenders for cars, houses, student loans, whatever it is, if you're getting a loan, it's kind of pegged off of the bond yields. Because think about it, why would you get a 3% mortgage loan if a 10-year bond's yielding you 4%, right? No, you're going to pay 6% because a 10-year bond is yielding you 4%, and the government's much more likely to pay you back than an individual borrower. Well, we could make the argument that maybe we're going to default, but that's still months down the line. So long story short, financial conditions have loosened a lot heading into Fed Jerome Powell, and that is not what the Fed wants to see right now. I think if you were to sit down in a room with the Fed and you weren't recording and it was just you guys talking, I think Fed Jerome Powell would say, I want the stock market to crash. I want it to go down and flush out one more time because there is still a lot of excess in the markets and valuations are still high. It makes the job easier if the crash comes when the economy is okay, right? Before things totally deteriorate, if they do, rather than the markets stay high and then you see a huge crash when the economic data starts to look bad, or maybe no crash at all, but inflation remains super high, right? The latter is the worst options. And I think that's what Fed Jerome Powell would tell you. So what is his real job, essentially? Well, it's to come out on that podium and tighten financial conditions. Tightening financial conditions would be upsetting the markets. The bond yields have been going down, stocks have been going up for a reason. They expect Fed Jerome Powell to be on the dovish side, right? Let's just be honest. They expect Fed cuts to interest rates by the next 3 to 6 months. We're not expecting a lot of dovish things from the Fed. So if we do get a lot of that hawkishness from the Fed, it's not going to be a good thing. And actually, believe it or not, this might be the first time that you have heard this, but the stock market typically rallies when the Fed raises rates. Typically, ever since the year 2000, or call it 1998, the Fed was raising rates up until the year 2000. Then what happened? The dot-com bubble, all of that. Everything went down. Everything crashed. And then even from 2004, this is one that you guys might remember much more. And maybe you weren't in stocks at the time. And if you were, well, The Fed had rates at 1% in 2004, rightfully so. And then they started raising rates from 1% to 5.25% until 2007, and then they started cutting rates, and boom, the recession came. Well, they raised rates a lot, and the markets went crazy. Mortgages went buck wild, right? It was a good time to be an investor, long story short. Well, not so much when the Fed started to cut rates. Same thing even back here in 2015. The rates were at 0, and they took them to 2.5% by April of 2019. And then they started cutting rates. They cut rates about 2 times before the COVID pandemic, because either way at that point we were heading into a recession. The yield curve was inverted in August of 2019, and then they cut rates to 0 because COVID came, right? Usually the best times to be in the markets are when the Fed is actually raising rates, not what we've seen in 2022. So 2022 was a real anomaly in the sense of stocks did bad when the Fed was raising rates. And now they're going to theoretically do better when the Fed pauses or cuts rates? No, they're not. And why is that? Well, the markets treat the Fed like they know everything. Like they know if we're about to go into a recession. And they probably do. But then the bigger question to the markets will become, if inflation is 6% or 5% or 4%, and the Fed wants to get inflation down to 2%, why are they pausing in their rate hike cycle or indicating a pause? Or why are they indicating they're going to cut rates? The only time they cut rates or should pause if inflation is 3 times its target rate is if they think financial conditions are going to deteriorate. And historically speaking, if you get a Fed pause, about 90 days after that, you get a Fed cut. And if the Fed is cutting rates when inflation is high, well, it's not going to be good for corporate profits. It's not going to be good for valuations in the stock market. So believe it or not, if we get a dovish tone of the Fed pausing rates or even cutting rates, I mean, that's going to be a negative thing eventually. And I say eventually because the markets might actually rally off of that for a day or two, and then I think people would start to realize, hey, this is not such a positive thing, especially with regards to rate cuts, because the historical data just does not look good when the Fed cuts rates. It's not good for the stock market. So there is that, and that's really in pertaining to Fed Jerome Powell. And tomorrow morning, you're also going to get the JOLTS job openings for December, 10 o'clock in the morning, and the ISM manufacturing PMI for January. Also at 10 o'clock in the morning, you are expecting the JOLTS job openings to go down by about 1 million from November until December. And I'm sure you guys have heard this before on the channel. This is probably not the first time you've heard this, hopefully not. But good news is now good news in 2023, at least for the economy, right? Bad news is bad news. Whereas in 2022, bad news, like really bad economic news, would give you some of your greenest days throughout the year. That's not the case anymore, guys. It's just simply not the case. As long as inflation continues to come down, that narrative will no longer work. That bad news is good news is bad news. But I think with the JOLTS job openings, the labor market is so tight. There's so many jobs out there. There's 1.8 jobs for every person looking for a job. Like, you can almost have 2 job offers and for every person. It's probably not going to be a terrible thing if the JOLTS job openings go down. Maybe I'm wrong on that. Maybe it'll show some weakness to a lesser extent, but I think it would overall be a neutral or a slightly positive thing if this does come under 9.5 million jobs. If it does not, I don't really expect a huge market reaction, considering later in the day you have Fed Jerome Powell. So that is a big part of this video. The other big part of this video is where you are at on a technical basis. You are not looking good as far as the technicals. And really, it's this line that I have drawn right here. This line, ever since May of 2022, has almost been respected every single time. The only time that it was not was in this August rally, before Fed Jerome Powell batted the markets down at Jackson Hole. And I mean, it found resistance here for a while, and it broke through. This was probably a lot of shorts getting squeezed, and then ultimately did dump under that, tried to retest it and could not, and got rejected. So right here was a big test, right here was a big test, here, here, and now here, and you actually got rejected off of this, and this level is at about 409.50. You got rejected at this level. Not even 409, actually. It's 408.50. You got rejected at this level January 27th, and you weren't able to get over that today. And I think if there was any day to get over that, it would have been today, and that would have showed you a lot of strength. But that move we seen yesterday, down 1.25%, really kind of threw cold water on this rally. Now, with Snapchat earnings did not paint a pretty picture for Q1 of 2023. And that's what people care about right now, is what are earnings going to look like in 2023? Are valuations too high right now? Well, according to advertising business, at least from Snapchat, it's not looking so good. And if it's not looking so good for Snapchat, it's probably not looking so good for Google, or for Amazon, or for Facebook, or Apple, or any of those companies, because they all have advertising revenues incorporated in their business models. Some more, some less. Obviously, I would rank that from Facebook the most exposure. Google would be second, or maybe flip-flop that. They're both pretty much solely based on advertisement. And then you got Amazon. They're pretty big with advertisements, and then Apple would be really the last one on the totem pole, but it's still about 10% of Apple's revenue. So you are seeing really bad guidance from Snapchat for Q1 2023. They said, quote, "On the monetization side, we anticipate that the operating environment will remain challenging, as we expect the headwinds we have faced over the past year to persist throughout Q1," the company said in a letter. And they kind of missed a little bit on everything besides their earnings per share was 14 cents versus 11 cents that was expected. So they did make a little bit more money. Their earnings per share was a little bit better than expectations, but kind of everything else missed by a little bit. So the 14% drop you were seeing in after hours is not because Snapchat just completely washed out their earnings like it was terrible. No, it's because their guidance for Q1 at least is not good. And that is also why you're seeing Facebook, Google, pretty much all other companies that are advertisement based falling as well in after hours. And I don't think this is going to set a good precedent heading into Facebook earnings tomorrow in after hours, and Fed Jerome Powell, and then the day after that, the three big dogs, Apple, Amazon, and Google. So hopefully you guys can see where some of these concerns are coming from on a technical basis. You're really at a huge level, and we've gotten rejected off of it. I mean, for a while now, ever since August. And if we don't break above it this week, if you see the markets fall, then you're probably out of this whole bull market in 2023. It's been straight up bull market. It's been really good, right? I think my portfolio is up like 45% year to date. It's been a wild ride. But if earnings are bad and the Fed can accomplish what they want, and that is to drive down the stock market, coming tomorrow, it might not look so good. Might not be a good next couple of weeks, especially if companies like Apple give us really unexpected bad numbers. And I'm not going to sit here and forecast that. I've been wrong before. I'm not that bullish, though, on Apple. So, long story short, guys, it's not looking so good. There is a bullish case here that maybe there's too much fear heading into earnings. But what we're getting so far is just not good for the markets. And that is basically it for this video. As far as AMC, the way that AMC will be affected out of all of this is really the direct move that you're going to get in the broad markets. Like, you're seeing these stocks sell off in after hours, the big ones that I just explained to you guys, and you're also seeing AMC drop 1% in after hours. Now, you are seeing AMC did close above that key level right here at it's $5.30 per share. You're at $5.29 right now, but you did close above that. So I do think that is a positive sign, at least for AMC specifically, and I do think earnings will be good. If we can hold up this level, I think you're probably going to be pretty excited with what happens after earnings, and I think there is a possibility to lead to the short squeeze, to lead to the MOAS if we get really good things that come out off of earnings, guys. But some big hurdles from now until then. On one hand, if you do see the markets come down, not a lot of people are exposed to this market. The VIX is under 20, and it really hasn't been under 20 throughout all of 2022. So there's not a lot of put exposure out there. There's not a lot of short exposure right now. There's a lot of people in cash or not in equities at all. So you could see people caught off guard, and that could cause an even bigger drop, and that could lead to even more said margin calls for hedge funds that need to raise liquidity. And a good way to do that would be covering on a short position that doesn't look very profitable to short from here in the first place. So that's it, guys. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Most importantly, enjoy the rest of your night, and I will see you in the next one.